Hey, what's going on YouTube? Welcome back to the channel. Today is March 29th, 2025. I just wanted to do a quick update and just show you guys some of the tweaks that I'm going to be doing on my strategy. These past 2 months have been pretty brutal for the market, and it just made me realize a few things that I could change to make next time when this happens better, and just based also on the underlines that I trade. They're pretty volatile in themselves. So there's a few things that I'm going to change here, and I'm going to show you on my sheet here. So this is my trading strategy, and I've already changed it here. But first, the main thing, if you get anything out of this, is basically I'm going to move away from being assigned shares unless we are at extreme low prices. That's when I will allow shares to be assigned. Otherwise, I'm gonna just keep rolling out and down, or just out, depending on the situation. Nothing's set in stone, just because the market can be unpredictable, like it is during these times, right? So let's just go over this real quick. I'm gonna read it out quick. So sell cash secured puts at different strike prices between 30 to 45 days to expiration. This creates a ladder approach to selling puts, which in turn follow the price of the underlying and lowers cost basis. So my plan, for example, for TNA, I can sell up to 5 cash secured puts. My idea is to either sell all 5 of the cash secured puts on the same strike price, or maybe sell 3 closer to the money and 2 farther down. I'm not sure what I'm going to do about that yet. Sometimes I feel like if I just sell the 5 cash secured puts on the same strike price, it'll keep things cleaner and simpler and easy to follow, rather than having different strike prices, right? But the one thing that I'm planning to do is just keep it on the same day to expiration. So either I sold 5 cash secured puts at 45 DTE, and then I'm going to sell calls and create a strangle depending on market conditions. The call will be between 10 to 20 delta, usually on the same expirations as the puts. So basically creating a strangle at 45 DTE. And maybe I will sell I might sell calls if I close the calls earlier, because I'm not planning to close all the strangle together. It all depends on if the market goes down and my calls are up 30%, I might close those calls and then open up another set of naked calls, but on a different expiration than the puts I already have. So it's all market dependent, but for the most part, I'm going to try to sell a strangle at the same days to expiration, and I will close them, and I will close the cover calls, or I'm sorry, the naked calls or the cash secured puts, depending on what the market gives me. Okay, I'm going to allow assignment on some of the cash secured puts only if at extreme discount prices. Otherwise, roll out and down, and sell a cover, roll out and down. I'm going to sell cover calls on the assigned puts, converting it into a cover strangle. Okay. Close cash secured puts at 50 to 70% profit. That's on a normal succession of whatever happens with the trade. Now, if I do a cash secured put, let's say I do a cash secured put on TNA today, and tomorrow it's up 30%. I'm taking that out. I'm closing that cash secured put the next day, because I got 30% profit in one day, rather than waiting for another 44 days to happen, right? Now, if at 30 DTE I'm at 70%, 40%, I'm going to wait till it gets to 50. So like I said, it's all market dependent, and depending on what the market gives us, right? I'm going to roll positions at 21 DTE and reset, no matter if at profit or at loss. So this, because I'm trading very volatile instruments because they're triple leveraged. I'm gonna close or roll my positions at 21 DTE to reduce gamma and just reduce volatility, because as we all know, the closer we get to expiration, the more volatile the options or the Greeks become, especially on these triple leverage ETFs. So it prevents me from taking big losses, because obviously as we all know, when we roll a position, we're really realizing a loss and opening another trade that overpowers, or or gets hopefully more credit than what we lost, and move it out in time, right? So by closing things at 21 DTE, I'm reducing a loss, or I'm reducing the amount of lost money, and then we're moving it forward and resetting. Okay, we're going to adjust strategy specs based on market environment. Look at the market fear greed index. If market is overbought, reduce risk, sell lower deltas on puts, sell higher deltas on calls. All right, so let me show you my TNA positions. So this is one of the reasons. See, I have these 200 shares of $42. Well, this was a cash secure put that I sold at 42 when the price was like down here somewhere. Okay. And because I wanted to get a sign quickly, because I thought getting a sign here at 42 wasn't a deal at the time. I didn't know this huge drop was going to happen. Maybe I thought, okay, they might drop here, but look how far we went down. So my shares are super underwater, even though I'm okay with it, because my whole backbone of my strategy is that I'm selling cash secure puts on broad market indexes like TNAs, the Russell. So I'm not scared that the Russell is going to go down to zero. But the fact that I'm assigned 200 shares of 42, it takes a lot of buying power, and I'm slowly crawling back by selling cover calls, but I do have to sell them below my cost basis. So these cover calls are meant to be for these 200 shares, but look at how far down I have to sell them below my cost basis, right? Which I'm fine with, because I can work around that, and I can always roll up and out until I get up here. But it's just there's no need to be just holding these 200 shares, in my opinion, when I can just hold the options, which is more versatile. It's a more versatile. I have more flexibility with them, because, for example, these 5 cash secure puts at 37 are also underwater, right? But with these, I can hold these. They take less capital to hold them, and I can just continue to roll them down if I can. Like if I get a nice green day, I can roll these 5 from 37 down to 36 or 35 and out, and just continue to maneuver my way around the price. But with these 200 shares of 42, all I can do is sell cover calls below my cost basis, and I'm kind of stuck with them at 42 until the price gets up there. All right. So that's the reason that I made that switch. Also because it helps. I think it's a better idea to do that, to do it that way with these triple leverage ETFs, which move a ton, right? Also, another thing I'm thinking about is just staying with these broad market indexes. So someone asked me on my last video, asked me what I thought about SOXL, right? So I think it's a great ETF. It's liquid. It has weekly options, easy to get in and get out of trades. But the only thing that I'm thinking about, this is a very niche ETF. It has around 20 to 25 stocks that are that are concentrated on microchips. Nvidia, AMD. So it's the semiconductor sector. So which is very concentrated and very niche, which is fine. I mean, it's all up to you and what you feel comfortable with. I don't think microchips are going to go away anytime soon. And with what's happening, most of them come from Taiwan, so that's a whole another story with what's going on with China and whatnot, and the fears of China taking over. So that's another whole thing to worry about. And I mean, like I said, it's up to you. This is not financial advice, and it's how comfortable you feel with the underlying. To me, I'm thinking about just staying with underlines like UPRO, TQQQ, and TNA, which are broad market indexes. They're basically the whole market. UPRO follows the SPY, which is what everybody uses as to gauge the market, to gauge things. So I feel safer with those, and also, for example, UPRO, which is less volatile than the TQQQ, which is the Nasdaq. Being triple leveraged brings enough volatility to where I rather just play with UPRO, because it's the 500 stocks rather than 100 on the Nasdaq. So that's my take on that. So other than that, I'm trying to make this video short. Let me show you my account now. On the last video, I was down $7,000. Now I'm down 6,000. So we're slowly crawling up. This market took a huge dive this last couple months, and in this past three to 4 days, it's 6 days. But it's been kind of crawling back since the beginning of the month. So I just keep on selling premium with cover calls and naked calls. And I have, like I showed you before, I have this Leaps cash secure put option here that's expiring in 262 days, so January 16. And we're up 14% in 6 days. So I'm going to keep it there. But like I said before, if for whatever reason the market tanks again, and I let this expire in the money, my cost basis will be around $49 on UPRO because of the huge credit I took. And this is at the money option that I sold. All right, and this is my account. So this is my account right now. I got 5 calls that just got to that today. You know how it's 0 days. I just got filled on these 5 naked calls on TNA, which I should add here at, 33. Let me go back to TNA. And let me add this trade right here. Or not, maybe. I guess my internet went out. Oh, here we go. All right, we're back. All right, so 5 calls, 52 days to expiration at 33. Let me add that there. So right there. All right. So those are my new calls there, the 5 calls that I made it a strangle, along with the underwater 37, 537 cash secure puts that I'm going to continue to hold and roll as the price hopefully continues to go up. All right, guys, if you have any questions, leave them at down on the comments, suggestions or questions. Thanks for watching, and you all have a great day. Bye.